Hey traders, welcome to Charts and Coffee. Great to see everybody. Hope everyone's having a good Thursday morning. We have still to come the biggest data release of the week. I know we've had plenty of big earnings, whether that be Netflix, Tesla. Earnings are spectacles, but they're not necessarily in any way. I'm not even going to hedge. They're not going to change what it is the Federal Reserve is going to think about doing. But data points like the PCE on Friday is far more important than any singular earnings release that we have coming up. So one is a volatility event that could give us some trades. The other is a macroeconomic data release that will change the way we expect the Federal Reserve to communicate and ultimately to act on the rate cuts that are coming, but the rate cuts that are coming up this year. March or May or June, it doesn't matter, they're coming. So then the adjustment is what? Well, take a look at bonds here for a moment. So bonds and notes are a neat way to measure, what's happening in terms of yield, because the bond play is, you can think of it as three things. It's, what are the Federal Reserve plans with rates, really specifically the FOMC, that's the 12-member voting body. What then do yields have to do in respect to a 3 to 6 month sort of time horizon on where rates will be? Because remember, when we're looking at the bond futures, we're looking at a contract that's measuring what we expect to see come March of this year. Then the last thing is really the bond market's sort of side gig, which is betting on economic issues, meaning the bond market will sometimes start to price in a recession. The bond market will start to price in maybe the Federal Reserve is not tackling it. That is a mess. Bonds like to play a game of chicken with the Federal Reserve. Here's the punchline. The Federal Reserve always wins. In the game of rock, paper, scissors, right? The Federal Reserve always wins. So if you take a look at bonds here, they're struggling, but they're hardly in a downtrend. They're choppy with some bearish momentum. And then if you take a look at notes, they're actually more resilient. You look at the 10-year, right? The 10-year yield versus the 30, and these are a little bit more resilient. They're still trading within their daily price movement ranges, which means we're not seeing outsized volatility. So no real reason to panic here. And then, oh yeah, have we mentioned that equities are climbing and NASDAQ's at all-time highs? So, this is where, this has been a common thing, and let's definitely get to the questions. If you have any, type them on in. Let me know what symbol you're looking at, time frame. If you have a position, if you want to put on a position, let me know. But here's the bottom line. Gang, there are folks out there, and they're usually on television. They're going to tell you all these terrible things are a-brewing, right? These are the same fools that said the same thing last year. Here's a look at the last year. This is January of 2023 to where we are right now, nearly February of 2024. And yeah, the shoe fell, sure, a couple times, but what has the market largely done? It's climbed, right? So too many traders listening to these people whose job it is, I guess, to entertain and maybe scare you a little bit. So you keep watching so they can sell you advertising. Let's be real. Those folks warning you about the fall are keeping you from all-time highs. Don't worry about the falls. Put profits in your account as you can. Whether you're a trader, whether you're an investor, grow the account. You know what's a great cushion for drawdowns? A little bit of cash and profits. There we go. So that is what we're going to continue to map towards, looking at the long side of a market that clearly wants to keep climbing, right? Look at the S&P. If you're a reader of the top tier outlook, you know that technology plus financials equals the S&P. Those are your top two weighted sectors. When those two cylinders are firing within this motor is going to continue to move higher. That's exactly what we've seen. Healthcare continues to be a quirky little corner of the S&P. It has benefited from sector rotation. It's probably the singular sector that we would say has benefited from sector rotation. So keep an eye on that as well. And that's where we sit, gang. Trade what we see, not what we think. Prioritize the trends, and onward and upward. All right, so let's jump into the questions. Let's see. Christian asks, so a question on China. Sure. So we have the FXI, which is the China ETF, and KWEB, which is the Chinese internet ETF. I tried to short the rip with no success. Do you think with China easing banking regulations, it will boost market turnaround like our Federal Reserve? So here's where I'll say trade what we see, not what we think. The question there would force me to give you an answer about the future that I can't see. I don't know, because that sense starts to creep into what do I think? I don't know, Christian. And, you know, newsflash, nobody does either. But I love what you're doing, right? The first half of your question is, let me trade what I see. And what you see, my friend, is, I agree, it's a downtrend. Short the rip. You know, whatever those banking regulations may or may not do, here's the thing. Anytime we have a bit of news, I'm going to presume I'm the last one to get it. I'm also going to presume it might take a little bit of time for equities to see what it means to them. So if you want to give it a moment to simmer down, to see if it's really going to change hearts and minds and where money is flowing, that's fine. As a general rule, though, as a guideline, anytime it's easier to lend money, borrow money, or anytime a central bank or a country is increasing the money supply, yeah, that's going to be good for stocks as a general rule. So then what I would say is, if you're concerned about that narrative sending things higher, find trends that are either sideways or poised at the beginning of their uptrend. Focus on longs there and leave things like KWEB and FXI to the downside. And then also, if you crack open FXI, remember FXI is going to be made up of companies within China. So, you know, if you head on over to Yahoo Finance or ETF DB and take a look at what's inside FXI, it could be a real eye opener. All right, next up, should I sell Intel or hold through earnings? So, Jan, it's a really simple answer. I never hold through earnings. I don't play earnings. I find them absolutely the noisiest nonsense that we have to deal with every quarter. Here's what I will say. Let's start with index sector stock. NASDAQ's moving higher. SMH is generally moving higher. And Intel's part of that rising tide. What's not to like there? Okay. The second part of it is, why would I sell something in a rising tide? It's in the bullish hemisphere. It's generally moving higher. So that's a different question. I don't know if you own it long, Jan, so clearly not enough for me to work with there, but sell as in sell and take profit, or sell as in short sell. I don't know which, but I would not recommend short selling as far as a net position. As far as holding through earnings, I never do. If there's anything that I want to do with earnings, is use the ramp up to earnings. There's about a 2 to 4 week window where implied volatility hasn't gone berserk yet. And if there's a trend, buy the dip. And I like to be out before earning. We do that earnings release. We do that in the Sector Secrets Mastery. Let's take advantage of the rally, which is the saner, longer, often far more profitable move. And remember, if we're playing through earnings, I know it's really easy to say, oh, but Netflix. True, right? I mean, it's generally speaking bullish, but that move to the upside could have been an equal size move to the downside, right? The downside. So I don't like reducing my trading to, you know, sort of this lottery scratch off ticket binary, am I really right or really wrong scenario? Because then you've got something like a Tesla, which by the way has been a short and only a short for the better part of this year. It's gone down. So we don't know what's going to happen with earnings, and I'm not going to put my capital at risk in an environment where it's really difficult to A, control risk, and B, we know earnings reactions may not move with the trend. So I would say if you're looking to get in long, wait for that move to the downside. If you're already long, I would exit before earnings. That's what I do. That's what I do. All right. Next up is good morning, gang. Thank you as always. I love all the good mornings. I love starting my day off with some coffee and some charts. What's not to like with that? Rainy days. Yes. Can we take a look at DKNG? Yeah, of course. You have earnings on the 15th. So that gives us about 20 days, right? We haven't then quite seen that ramp up in implied volatility. Let's Take a look at the daily time frame and the structure there. All my cards on the table, rainy days. I don't trade this stock all that much. I don't have any skin in the game, but I'm happy to offer some analysis. Bullish momentum has started to kick in. I can see that with the green lower row on my indicator at the bottom of my chart. I can see that with the green grab candles, of which we now have 5 in a row. I don't have a trend here, and there's a pretty good argument, rainy days, that based on the previous Darvis here, this is automated support and resistance, the minor high that seems to be forming, and take a peek here. This is the overbought, right? That's an overbought read on the slow stochastic. Why is the slow stochastic relevant in this environment? Use the right tool for the job, right? In a neutral environment, we're looking at CHOP, and the best decoder that I have found for CHOP is a slow stochastic. Add the Darvis to it. This could be overbought. So I'm not saying that it may not move higher, but if I was going to be a buyer, it wouldn't be at this area between 38 and a half, 40. I would wait for it to become oversold like it was, quite frankly. Take a look at my little arrow here. This is just a slow stochastic, gang. If you haven't put this on your chart to trade CHOP, listen to me now, believe me later, it just works. And that's what we want to take advantage of, these oversold stochastic signals at support. So that would be where I want to get long. And this might be where ultimately a short might kick in. All right. Question from our Simpler Essentials room. All right. So let's see. Bear with me here. I think I saw the question. A, B, and B. All right. Hey there, Laura Mack. All right. SMAs and EMAs are stacked. Okay. Got a mild squeeze. All right. What's the question here? MACD. Oh, is there a question? No, no question. All right. Airbnb is in CHOP. It's not quite overbought. It's not quite oversold. I would be okay. So let me show you okay, Laura Mack, you're going to love this. You're going to love this. Let me show you something here. And this is going to absolutely increase the probability that you're looking for a momentum breakout, which is what a squeeze is. And look, there is one way, and I will say this because I've observed this now watching John long before the simpler days, decode momentum breakouts. There is one momentum tool that I have seen work throughout the time that I was introduced to it, and that is the squeeze. I have further found, just now, once I was aware of it, the squeezes work best in compressed markets, right? As opposed to choppy markets. Squeezes and everything work great in a trend. So if you're looking for a really great, time-tested, I don't mean a month. I don't mean, oh, wow, I discovered this 6 months ago. I mean, decades. It's John's squeeze. I think we all know this. It's a flagship indicator. So you might say, well, Rog, do you use momentum breakouts? Not my cup of tea. However, I will tell you, much like a lot of folks, I've studied the way in which it works best. First of all, you always need directional bias. So if I'm above the 200, this is so Laura Mack, let me show you the two differences and then you take from it what you will. When the Darvis, the automated support and resistance, these two lines right here, which by the way, work wonderfully well with any type of process that you want to use. Anytime we can see a narrow Darvis, you've got a compressed market. I've got a compressed market here above the 200. Notice every one of these cues are automated, and therefore all I need to do is read it and say above the 200, check. Bullish hemisphere, green grab candles, check. I'm looking for a breakout, right? So let's get the direction of the breakout solidified. Now I've got this narrow little Darvis. This is what I'm looking for, that breakthrough. And if in an environment you see a squeeze forming in a window like that, Yahtzee. That to me, is excellent. Compression, definite directional bias, and then go from there. Now notice I don't have a compressed Darvis here, do I? I don't have a compressed Darvis. And so the way in which I would focus on this, right? And by the way, as a general rule, I don't want to be short selling. I don't want to be short selling above the 200. All right. So then the next thing I would say is if I don't have a compressed market, the next thing I'm going to look for are neutral candles. So the more of the yellow and orange candles that I see here, the more that we're starting to get a mild compression, which kind of lines up with what you're mentioning. But do you see the difference between the Darvis just absolutely like a vice grip, smushing down on price with the 200 below it? That's beautiful, right? This time, it's a little wider a range. We still have the 200 below it, and now we're getting some of these little neutral pockets, and that's probably where you're seeing the mild compression, right? I will tell you this, the closer we can be to a buy off the 200 and off this Darvis, the better, because that affords us two things. If I wait for 150 to break, I'm buying a new high pretty much, aren't I? Meaning a new high in terms of the last handful of months. And then my tolerance for profit and risk are very different. I need people to continue to buy higher highs, right? I need the market to go somewhere it really hasn't been willing to go in about 4 months. However, if I wait for an oversold buy, if I wait for a minor low along the Darvis, an oversold stochastic, if I wait for some kind of pullback inside this range, the cool thing is because it's a wider range, right? I can get in here. I have the luxury to get out and pay myself here, right? So notice the size of the Darvis gives us different choices like that. I hope that helps. I hope that helps. And that's what I'll look at. Color code everything. Use very clear levels that determine bullishness or bearishness. And then that's the way, Laura Mack, I would view that. Okay. As far as yeah, everything else you're looking at there, I don't use those tools necessarily, but here's what's cool. We have two different processes, and I think we're coming up with a very similar take. So those of you that are not familiar with the way I look at compression to expansion, right, which is essentially momentum, squeeze, and the grab candles and the Darvis, amazing combination. All right, next up is, let's see, on DraftKings. All right, let me go back on over there. Stefo asked, do I see them going higher with Super Bowl coming and possibly Barstool's purchase? So I'm gonna answer that the same way we answered the China question. Start with the structure, trade what you see, right? Is this moving higher? Generally speaking, I wouldn't want to be a bear, right? Maybe near term, there's some resistance, but I would say the best place to be is looking at an oversold buy. Even though I mentioned we're at resistance, that was more of a warning not to buy up there, right? Let's wait for a little bit of a pullback and then we can look at the upside. All right, the next thing I would say is the rest of it is what we think, right? What I see is this DraftKings moving higher, the narrative about Super Bowl. And by the way, Steffa, if you and I are talking about it, let's presume there's a lot of other people that are thinking the same thing, and it's probably already getting discounted, right? We're in playoff season. Let's be frank. I mean, DraftKings is busy all season long. I imagine as it goes into playoffs, right, we're seeing even more. And hey, by the way, if we're going to think about different catalysts for increased betting, Super Bowl's big, but not as big as, I don't know, I'm not a bettor, but I think March Madness is pretty huge too, no? So we have some things between February and March that I think would be seasonals. You want to think of it as a seasonal, Stefo, right? I know wedding season in India has an impact on gold, right? Could the combination of Super Bowl to March Madness have that same thing? I don't know. Look back on a few years and see. You can do that on Season X when I look at seasonal, but I would look at that as possibly a seasonal tendency and see if that is something that pans out. If above the 200 and if in largely a climbing environment, and then now you superimpose, right, that potential seasonal could be something to think about because there certainly are seasonal aspects to the betting behavior, right? Yes, it's 12 months a year, but I would say I'd keep an eye on that. All right, cool stuff. John asks, where can I learn more about the Darvis indicator? Yeah, absolutely. So, by the way, for those of you that may not know, Lorna Bott and I are working on the indicators that will be my next class, and that's going to be coming up in I think about 6 weeks now. And Darvis is my automated support and resistance indicator. It's part of a suite of tools that I use that comprise something that we've been calling the TOPS system since, I don't know, 2015. So what we have here in the Darvis, which, by the way, John, if you're a member of Sector Secrets Mastery, um, and by the way, you can go to TradingView even just right now and go to the indicator section, and we've made this tool, the Darvis 2.0, available freely for many, many, many years. So if you're looking for automated support and resistance, it's just about as good as it gets, and it's free. So who doesn't like that price? We do have a Darvis 3.0 or a Darvis Signals, but this is a great place to start. So the best way that I can tell you, John, to start learning about an indicator is start getting visually comfortable with it. Throw it on your chart and start seeing what it does, and then start looking at the tools you might have already to say, okay, what would I do when price was here? Right? Do I have an indicator that's syncing up with those things? That's the best way to do it, sort of on the job. All right. And then after that, if you think, okay, Rog, I'm digging this, well, come check out what we're going to be doing uh, in a couple weeks, and we'll start to fill in the holes that you might have on, just how much that Darvis can do for you. As always, gang, thank you so much for joining me for Charts and Coffee. I will see y'all tomorrow, same time, same station. Until then.